Welcome to the daily update where I'll go over the action in the market for Friday, August 22nd, and we'll see how things look for Monday, August 25th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right, there was positive reaction to Powell's speech, and it looks like there's probably going to be a rate cut in September. At least the Fed appears to be open-minded to that, and that's what they gathered from the speech. And so we had a nice update, over 1.5%. The Dow set a new all-time high. The S&P did not, and nor did the NASDAQ or NASDAQ 100, but we had hit some pivot point support levels with the NASDAQ and NASDAQ 100 and then came up off of that. But we didn't set a closing high, but there is some improvement. Now, when you just look at the chart of the S&P, yeah, okay, all right, it's looking a lot better. We're not seeing much of a change with our growth to value ratios. The market still appears to be getting more defensive. And even with the update, the volume picked up, but it's still below average. So is there going to be some more carry through to this? But there were some improvements. We're back to looking positive in the short term since we were able to reclaim the 20-period simple moving averages. Okay, so right at the open, we had a gap higher open above R1 at 63.92. Then we were able to get back above 6,400, and we quickly got above R2 at 64.13. We even went above R3 at 64.54, and right about the time we got a little bit above this longer-term overhead resistance that we've been watching at 64.68, and that's where we started to really slow down with price. And then from there, we chopped between 64.75 and R3. That was to the downside, and we closed above R3. We were up 1.52%. Volume is still below average. We're back to looking positive on all three time frames. Interest rates came down because if there's a rate cut, that's helping the small and mid caps. And when interest rates are falling that way, the small and mid caps had a pretty good day. And so, yeah, everybody seemed kind of happy with things in Friday's session. Some comments where the Dow did set a new all-time high, and there was positive reaction to Powell's speech, reinforcing this idea that the Fed, we're not sure by how much, but that the Fed will cut rates in September. Now, this was a year ago when they cut rates 0.5% or 50 basis points at that time. So that could feed into the scenario that the market has been developing. And one thing that Powell said, instead of, yeah, we might cut rates, he has to come in and say it in a more fancy way. With policy in restrictive territory, meaning rates have been higher for longer, the baseline outlook and the shifting balance risks may warrant adjusting our policy stance. And the market just said, okay, that means he's open to a rate cut. And Cleveland Fed President Hammack, who's not a voting member, is more hawkish, but the market really didn't pay attention to this. Said, well, of course I'm open-minded, but she's more concerned about inflation and still feels that the Fed isn't living up to its mandate of a more stable environment, stable prices, full employment. Small and mid caps had a good day, and growth did outperform value, but not by much. And the U.S. has now taken a 10% stake in Intel to help the company. Now, we haven't really seen this since the great financial crisis. The government did this with car companies, with some insurance companies. AIG was one of those. Now, if you're a pure free market capitalist, you probably don't like this because that means the government's coming in buying shares of a company. And if you're a shareholder, you can vote, you can make decisions, you can have an impact. It's like, okay, if you like the government to be more hands-off, it's like, let us sink or swim by our own efforts. You just stay out of our way, government. Thank you very much. Or other people are like, well, they're a big company. And Intel used to be big. Where we wait for NVIDIA earnings now, we used to wait for Intel earnings to come out. But they've drifted down as far as the impact over the last couple of decades. They were big during the dot-com boom as well. So you could make a case for either side on that one. And we are looking a little better in the short term. We now have at least one of our indicators. The Williams percent R is extreme positive. We still have the other ones that are improving, the Stochk RSI, the CCI charts, and the short-term stochastics is now back to looking extreme positive. And we're in the intermediate term, we have the Sean trend meter, which is now turned back up. And then we're still far away from that 50-period moving average as measured by the boom indicator. And we're getting kind of extreme too, even in the long term with our 150 simple moving average as well as the 200-period simple moving average. I'll show you all the charts of these. No, I didn't change any of the overall scenario because the Fed is still kind of wait and see. We're open-minded. We're going to just see how things go. Now, we still have about a month until that meeting. A lot of things can happen. And there's going to be a lot of reports, economic reports that come out, and we'll see if this scenario can actually stick. And the dollar was down, interest rates were down. They did fall quite a bit to 4.26%, where after Thursday we were at 4.33%. We're back to positive now as far as sentiment. We had drifted down to neutral. That was at 53. Now we ticked back up to 61, which is positive. And we are positive with our trend, but it's still a weakening trend. We have not crossed back above the moving average. The ADX is still continuing to decline, but we're positive because the green line is above the red line. We're trending because we're above 20. With the update, the bias is positive. I'm still keeping the momentum at mixed because the week was spent in frustration and not an awful lot of conviction going on. And then this was more of an emotional reaction. You can tell that by how the market went up right after the open and then just kind of hung there. We need to see more follow through to shift the momentum back over to looking more positive. All right, we didn't have any economic reports. Powell was it. He was a one-man show, at least in Friday's session. So there's no charts to show you there. Then going into the real investment advice, this is showing the Fed funds rate and CPI and how they tend to track along with each other as well. And then long wait in between cuts can be quite bullish. So here, just going back to 1970 here and how many months there were. Now we're getting close to, what was it? Well, I guess we'll be at 9 months right now. That's when we cut rates back in September. Okay, this should be 2024, shouldn't it? I guess we're waiting to see if there's going to be a rate cut. So at the 2025 meeting, but shorter term, not so good. Not much of a return there, only up a little over 50%. But then the further out you go, the more it tends to improve. Then valuations, and I'm going to show this chart in the intermarket analysis video. That's where we really look more at valuations. U.S. still overvalued when you look at developed markets and emerging markets, which are more fairly valued. And the equity market internal pricing of economic growth, that continues to go up here. Again, where we're looking at an index return of cyclicals against defensive. Cyclicals trend more with the economy. Defensives, which we're still kind of becoming more defensive right now, but you track this over time and then the consensus looking forward of real GDP, which we're seeing an improvement there. And forecasts are also, we're going to get another read on GDP coming up this week. And then earnings revision, they're revising things to the upside, which has been helping the market to stay more positive. And then value, something we've known, we can look at all different kinds of charts here, but valuations gaps are extreme, looking really big here with the price to sales spread, the price to book. This is if you sold everything, the book value of a company on paper, and price to earnings. And then the dividend yield, which are profits that are paid to shareholders, that continues to go down. But we've been seeing this now for quite a while. And the financial conditions index, drifting down a little bit when you exclude equities, but we're tending to go down here and getting a little more loose with the financial conditions, and that could help the market overall as well. Then the data surprise, and whoever this is, Anna, the economist, I guess. My takeaway from Powell's speech is that September is still really down to forecasting the data, CPI and the non-farm payrolls. True, the bias is somewhat in the direction of a cut, but I don't think the sureness in the market pricing accurately reflects the risk. Okay, so we could still justify that, but Anna doesn't seem to agree with that. And then Fed cuts versus CPI. And if you want to pause this and look at it, there's these kind of convoluted charts in here of how things are going to change according or how they've been performing lately. When the core CPI is above 3% and rising, the Fed has only cut rates one time, and that's over here back in the early 90s. If the August CPI remains above 3%, then a September cut would be the second case. The only other time was in December of 2024. So it's not, if we get another CPI report and it comes in hot above 3%, it's going to be that could throw a rain on this whole parade of the Fed cutting rates because they don't do that very often. Then the Magnificent Seven versus the rest of the stocks, the balance year to date returns for the Magnificent Seven, just they're starting to catch up a little bit here as we're seeing the Magnificent Seven coming down slightly here. The dash line, these are the rest of the stocks. And this is part of the defensive posturing. Now, you could take that in a positive way too. That just means more stocks in the S&P are participating here, but it's not like they're really going up, and the Magnificent Seven have been coming down. Then the breadth, short-term breadth is broken out, while longer-term breadth has made new year-to-date highs. So we see that on the charts that we look at as well, where we're finally breaking out here on both of these charts. Okay, and then the S&P versus breadth, and then of course there's folks that say RIP bears, just looking pretty good here as far as this upward move, and then here's the data to try to back that up. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, so we didn't gap up all that much. We did have a gap higher open, but then we quickly went above R1. We kind of took a little breath here at about 6,400. And then pow, we just really went up to R3. We were able to stay on that. This looks like a big M. So if you want fries with that rise in the stock market. And we were able to stay the rest of the day above R3 and then close a little bit up off of that. But we're still down below this resistance level. And we did kind of stall out here around the 64.75 level as well. Pretty much all the gains we're seeing, we were positive with the futures, but all the gains were seen during the cash session, and then we were able to hold on to those. And this is where we're still seeing value outperforming growth. The red line's above the green line. It's the blue line here. Now, there's an improvement with both of these, but you'd like to see the blue line come back and overtake the red line again on the intraday chart. We're still tending to go lower here with the S&P growth to value ratio intraday. We did improve. We were above the dashed line here, which means we were positive, but not a big upthrust move that we've seen before. So growth was up more than value, but value was up strong too. But the mid caps, growth underperformed, and even the small caps. You had growth up 3.64%. That seems pretty good. But value was up 4.28%. That's where we saw a lot of the strength here. So we're coming down, and we're dropping below the moving average with our small cap growth to value ratio. Still not really changing much with mid cap growth to value, and just ticking up a little bit here with S&P growth to value. So not much of an improvement that way. And not much of an improvement with this growth to value ratio either. We just ticked up a little bit, and we're still in the upper end of the rainbow. We did improve with discretionary to staples. We're finally seeing a little bit of a breakout here, and that's positive for the market. And we're back to looking more positive here with the short-term trend. The ADX, it's turning up, but it's not above its moving average. But the green line is above the red line, and that is positive, and we are above 20. So we're in a positive trending environment, but it's a weakening trend until we actually cross back above the moving average. Also below the moving average, and the ADX is still continuing to decline here in the intermediate term chart, but we're positive with the green line above the red line. Below average with volume, you can see that little bit of a histogram notch down here. Even though it picked up, it wasn't a real big surge in volume. And we did decline with the VIX, so fears coming out of the market, both with the line chart and the bar chart. And this is what we've been wondering. It really hasn't happened up to this point, with the VIX going up seasonally from August into September, even going into October and possibly even into November, with the VIX really declining. Excuse me, the VIX really going up. That means stocks are declining. And we saw a big drop down here with the VIX of the VIX. So the volatility of the VIX did fall below the moving average with the bar chart and the line chart. We saw fear coming out of the market by this fear gauge and this other fear gauge as well. We saw a drop off with the daily equity put call ratio chart, but we're ticking back up ever so slightly with the 5-day chart, but we're still declining with the 10-day chart. And not much of a change here. Now it improved. We were up 2.9% with the high beta to low beta ratio, but not really breaking out. We were kind of back into this range that we've been in after we had been seeing more of a conviction here. What we want to see going forward is this ratio continue to go up and surpass these previous levels if we're going to switch back and look more positive. And didn't see much of a change. We're still at the high end of the range when we look at volatility risk premium. And we did improve with the advanced decline line, not quite setting an all-time high here based on price. That, I don't know the actual number. That could be an all-time high. But we're seeing still a little bit of a lag here when we look at the advanced decline line based on volume. We haven't gone above this previous high here, but they're still positive in the bigger picture. And we're going up and positive with the short and intermediate term advanced decline ratio. We're still above zero and going up, but not with a lot of magnitude right now with our 10-day advanced decline ratio. And we did see an expansion of the new highs, so that's helping the 5-day and the 10-day chart to go up. We're back to positive with our 3 smart money indicators. We're above the moving average in the bigger picture. The boom indicator is now turned back up and it's above its moving average. And not a lot of conviction here, but we're turning up barely with the Chaikin money flow. And we're back to positive with the Chaikin oscillator. And we actually ticked down a notch here with the vortex, with the green line coming down, but the red line also declined, but the green line is still above the red line. And we saw some improvements with all of our advanced decline line studies across all the different indexes. And we did see an improvement with those stocks in the S&P above their 20-period moving averages. Not extreme. We're above the 70 level. That's kind of the initial extreme area, which I don't have marked on this chart. If we get above 80, that's when we're starting to look quite extreme. But that is an improvement. We also improved with the 50-period, 100-period, and 200-period moving average studies. And we're kind of back to dealing with this pivot point here. We stalled out here. We started to come back down. Now we're kind of right back up to these previous areas here where we are not setting a new all-time high. But, okay, it's still positive nonetheless. We did see a pickup in volume, but we're still below the moving average. And we're almost extreme here with our 20-period moving average study, where 80 is the level. We're at 79.8 here. We're improving with the 50 and the 200-period moving average study, crossing above the midpoint with the Stochk RSI, but we're not up here into extreme positive territory yet. But the Williams percent R is. And so that's one short-term indicator that's seeing positive momentum in the short term. Back above the midpoint with the CCI 14 and improving, but not extreme with the CCI 20. We are extreme with the short-term stochastic, turning back up, but we haven't crossed above the moving average with the intermediate short term, and we're leveling off after declining with the long short term stochastic. We did get back above the midpoint with the force index, so that had gone negative. Now it's drifting over and turning more positive again. And we're just kind of roller coaster ride here. We were seeing some vulnerability with the short-term trend as we were coming down. Well, now we're starting to turn back up. So that's showing an improvement there. And we did recapture the 20-period moving averages. We closed just slightly below them on Thursday, and we got back above them on Friday. And we're back up into the +2 channel with the standard deviations chart. And not much of a change here. We actually ticked down a little bit with the balance of power, but it's still positive. And we've gone from more of a negative back to positive with the go, no-go with the darker blue bars. We're back up to the highest high value above the midpoint. That's positive there. Now we're on day 79 of this trend, upward trend that started back right at the beginning of May. And we're still positive with the proper order. We're back to looking positive. We were a little concerned about this. The TTM squeeze was picking up this decline that we had been seeing, and the market was looking vulnerable here. Now we're back to a lighter shade of blue, and it's going back up. So that has turned back to positive. And not much of a change, but we're still above zero with the ease of movement. No change here, really, after we saw a drop off after Thursday with the Arun. And we're still above zero, though, with the oscillator here. And we're back above zero with the S&P McClellan oscillator. So we're really choppy. And we're turning up based on price, and we're also barely starting to turn back up based on volume. We're also back above zero with the NYSE McClellan oscillator. Choppy in here, but we're going back up with the summation index based on price and volume. And we're back to positive with the Swellin Trading Oscillator. We were negative after Thursday since both were declining. Now we're going back up based on price and volume, which has turned this back to positive. But momentum, I mean, it's going to take more than one day to really change this. We're still drifting lower with the PMO. We're seeing a bit of an improvement above the moving average based on price. We're actually declining and below the moving average based on volume. And that's part of the concern that we're seeing here. But the PMOs that are rising, that's improving. The buy signals are going up. We're still level here with the PMOs that are above zero. We've gone from negative over to positive with the Elder's Impulse system. We're still positive with the parabolic SAR. We're trying to turn up with the short term. We're just barely above the moving average after we had been flatlining here with the slope oscillator, but we're still below the moving average with the MACD. So we're improving here with the slope, but the TSI, it's flattening out and still below its moving average. We're still declining with the intermediate term oscillators, and we're also declining with the longer term oscillators. We're going to need to see more follow through that way. But we're hanging on to just barely being positive here with the Copic Curve momentum oscillator. And after we had been declining, the Sean trend meter is now starting to go back up and into this darker green area. We're still above 50 with the money flow and the ultimate oscillator. We had fallen slightly below the moving average with unbalanced volume. Now we were able to recapture that on Friday. So that's looking back to being more positive. And we never did fall below 50 with the intermediate term RSI, and we're bouncing back up. We fell a little bit below 50 with the short-term RSI, and now we're back above 50. And we recaptured all three of these lines here. We had fallen below the green line, and we were dealing with the red or orange line, with the blue line acting as support. We were able to close back above all three of these lines again. That's positive. And we're still tending to go up here with the intermediate term trend based on 50 periods. We were able to recapture the blue line, and the red line is still continuing to go up. And we're back above all the moving averages, where we were a little bit below the 20 period moving averages. We're not far away from the 20 period moving average, but we're kind of extreme here when we measure the distance from the 50 period moving average. The bullish percent index did advance and is above its moving average. That's positive. We're going back up with the NYSE bullish percent index, and we're right at 50 now with the NASDAQ 100 bullish percent index after it had dropped below 50. And we still have a praying bottom fisher here. So, all right. Yeah. Then this is what I've really been focusing on lately. We closed at 64.66. If you want to round it up, it's 64.67. 64.68 is the overhead resistance that we've been dealing with. We couldn't clear it last week, and now this is a weekly chart. We didn't clear it this week. Is this still going to pose some kind of a problem here? We got above it a little bit last week, but we were not able to close above this R1 overhead resistance level now. So it's still considered to be overhead resistance. And we're at the upper end of this trend channel, just kind of camped along. It's the upper line and it's positive, but we haven't been able to break above that. And we're looking more positive here with the Heiken Ashi, turning back to the open candle. We're pointing up again with the Kagi chart. That's positive. The Renko chart is positive, but the three-line break is still not convinced that things are turning positive, at least yet. Long term, this is where we're getting extreme with the 150 and 200. We're just right. I had this set at 350, and we're at 351 with the 200. and we're clearly above the red line here with the 150. Now we could go above this if we're going to get into a really solid upward move. It doesn't mean we have to stop right here. This is just when we start to pay closer attention to this chart. Back to positive on all time frames. The NASDAQ 100 had shifted over to being negative in the short term. It's now positive in the short term. And we're positive on all three time frames with commodities, negative on all three time frames with the dollar. Bonds are positive in the short and intermediate term. And all of the sectors ended up being positive. You might say staples were down because they were unchanged, but we saw discretionary really leading things, and that's a growth area. That's positive. But communication did well, but it was further down the list, and then tech was even underneath that. And even healthcare and utilities. It was like everything went up except for staples. A lot of green here. Canada set a new all-time high right at the open. Discretionary had a bearish MACD crossover, but then did better later in the day. But then the Dow got above 45,000. The S&P got back above 6,400. NASDAQ was above 21.2, 21.3, 21.4, 21.5. Then we saw the Dow setting an all-time high, real estate having a BPI cross above 50, and then the energy sector had a BPI cross back above 50 as well. So to a large degree, it was an everything up day, but value is going up too. A lot of green here. Walmart was down, not so happy in that front. Coke down a little bit as well, but a lot of green with the big areas here. Nvidia, Microsoft, Apple, Google, Meta, Amazon, Tesla, they were all fairly positive. And we did see an improvement here with the equal weight version of the S&P. It's matching up more with what we're seeing with the weighted version of the S&P. Here's the Dow at a new all-time high and closed slightly above this R2 pivot point. And we're positive with the Elder's Impulse system for the diamonds. Then we came down to this pivot point here with the NASDAQ, and we've been able to bounce up off of that so far. So that's showing some improvement. And we're positive after being negative with the NASDAQ with the Elder's Impulse system. We fell a little bit below this pivot point, but now we've been able to come back above it with the NASDAQ 100. And after being negative, we are positive with the Qs. With the Elder's Impulse system, we're still negative with the momentum of the NASDAQ 100. And we were able to get back above the short-term trend here. The QQQs are back above their 20-period moving average. Still above the trend line on the weekly chart of the NASDAQ 100 going back to 2009. Almost at a golden cross here for the small caps. They were up 3.8% with the S&P 600. And we're probably going to generate a golden cross here unless we see a big dip really quickly. And the Russell 2000 small caps, they were up 3.92%, starting to get extreme with the RSI, but that could still go higher. We have been in an uptrend here, and we're looking more positive with the shorter term momentum. Positive with the Elder's Impulse system for the small caps. Mid caps finally breaking above this R1 pivot point, and positive with the Elder's Impulse system. The Wilshire setting an all-time high. That's good. That's a broad market measure, and it was up pretty solid there. And we're setting a new all-time high with the total U.S. stock ETF. Financial sector was up pretty solid too. Again, it's looking pretty good. This might even be an all-time high with this sector. And we are improving, but we've got a lot of damage to repair here when we look at the ratio between the financial sector and the S&P. We bounced off the 50-day moving average with the FANG index. Not back to an all-time high, but it did improve. So Apple was up 1.27%. Amazon was up over 3%, back above its 50-day moving average. Microsoft bouncing off of its 50-day moving average, up 0.59%. Google could be a closing higher, at least really close to it, but that's looking a little more solid. Bouncing off the 50-day moving average with Meta up over 2%, and Nvidia was up 1.72%. So these stocks are looking good. They're not falling apart. So we'll see if the growth aspect is going to come in and take over again. Tesla was up over 6%. It's been so choppy, up and down, above and below its 200-day and 50-day moving averages. Netflix was actually down a little bit. Apparently, they haven't had some good movies lately. And this is improving here. The home construction, the 3 to 7 year bond, that's the kind of environment the home construction likes. And now it's starting to outperform here. We have interest rates going down, possibly the Fed cutting rates. And so this ratio has now been going back up. And we're actually dropping off a bit here with the short-term correlation between US and world stocks, still leveling out with the longer-term correlation. Oil was up slightly into the upper end of the 63 range. And the dollar was back down, fell down below its 50-day moving average, also in a longer-term downtrend. Here we saw a drop off of the 10-year yield after it had been climbing overall here. So that's more friendly for the market. And we were up with the 10-year based on price. And not much of an improvement with the Qs to S&P, actually declining below a moving average that is now starting to roll over. We did see an improvement, and we're above the moving average with discretionary to the S&P, but we're below the moving average when we compare large cap growth to value. And still below the moving average with the large caps, mid caps, and small caps. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So what's the outlook then for Monday? We're back to looking positive on all three time frames, but we still have this overhead resistance. And we're going to get new home sales in Monday's session, and then anything geopolitical that may develop over the weekend, or any kind of trade deals or tariff news that could have an impact on the market there. Here is the economic calendar for the upcoming week. We will get durable goods on Tuesday. That's a fairly important one. We're going to get some housing data as well. And then we're going to, that should be second, not anded, just at and. But initial jobless claims, that's kind of a big deal these days. Now, GDP might be a big deal, or it might be a nothing burger, because we already saw this number once. And if it's not much different than what we saw before, the market really won't pay attention to it. And I don't know what's going on with my color scheming here. Friday's going to be pretty big. We're going to get core PCE. That's the other main inflation report that the Fed likes to pay attention to. We watch CPI as well as this one. At the same time, we'll get personal income and spending, and we're also going to get consumer sentiment. So it's going to be pretty heavy this coming Friday. Here's also a look at the economic calendar for the upcoming week. Seasonally neutral to positive with the Dow for August 25th, where we are positive for the S&P and NASDAQ going back to 2002. We're beyond options expiration week now, but we still see some tendency. We haven't really seen it yet. Maybe we're going to change this year, but this is where we see negative seasonality in August that really hasn't materialized all that much. Because if you go back to 1950, we have yet to be positive. Maybe this will end up being the first year. We've still got another week left of trading. This also shows how August tends to be more negative. Now, this doesn't include the move back up here, but this also shows the negative seasonality when we go through September and even into October. So we're still looking more negative with our oscillators. Now the Copic curve, I want to keep these together, but the Copic curve is still positive, but it's pretty much flatlining now. And the momentum for the NASDAQ 100 is still negative, and we're still dealing with a -6 reading with the Zohorchak method after it had been at a -10, but it's still negative. And then the positive side, accumulation distribution, looking positive there. We're kind of positive here. The red line's kind of going up with the Chaikin money flow, but the Chaikin oscillator is more positive. And our growth to value and discretionary to staples ratios, they're not improving a lot, but they're still positive. And we're back to looking positive with the McClellan oscillator and summation indexes for the S&P and NYSE. Swindler trading oscillators back to positive. The parabolic SAR remains positive. Bullish percent indexes. Now we're right at 50 with the NASDAQ 100, but the S&P and NYSE are advancing. Ease of movement, money flow, and ultimate oscillator. They're all above 50 and are positive. And the vortex continues to be positive. The financial sector, positive all by itself, has some damage to do as far as repairing if we're going to get back to outperforming the S&P 500. And we're working off of a Pring bottom Fisher buy signal. Not sure that was much of a bottom that we set there. And then the long-term special K chart. That's a daily chart, which continues to be positive there. Here are the pivot points for Monday's session. Pretty wide because we broke out to the upside in Friday's session. So the conclusion, we're back to looking positive on all three time frames, but the market is still looking like it's getting more defensive. And we are still dealing with that longer term overhead resistance, 64.68 on the S&P. We're back above the 20 period moving averages in the short term. We are seeing some improvement in the intermediate term. We continue to be positive in the long term, even though we're looking a little bit stretched with our 150 and 200 period simple moving averages. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.